Think this bull market's out of steam? Think again, history tells a different story. Goldman Sachs' Tony Pasquariello breaks down why the market's main trend remains upward, even as skeptics warn of overvalued tech stocks.
Okay, it's a bull market. The primary trend is higher. We want to keep our eye on the ball, that is U.S. mega cap tech. I think as we sit here today, the market's had a few things on its side. Earnings for sure have been better than expected. So very simply, the S&P 493 in the first half plus 7%, good. The Magnificent 7 plus 28%, superb. And then financial conditions have been getting easier and easier as we speak. I think the market today is basically saying we think the Fed's going to be cutting into a cyclical acceleration. So the big dynamics in the game are favorable. Now, the market's been on a flagpole for the past 5 months. This is one of the best risk-adjusted returns in our careers. So tactical risk reward, maybe not as good as it was at the start of the summer, but the balance of risks, positive.
One of the most important things I think you said is that the Fed is set to cut into a cyclical upswing. The premise being they're not cutting because they have to. They're cutting because they can. And that's one of the reasons why stocks are going to do well on the other side.
So our view is they're going to go 3 times this year, September, October, December, so sequential. 2 more times next year on a quarterly pace, makes 5. So when we're sitting here next June, the funds rate is not 4 3/8, it's 3 1/8. Growth this year, U.S. GDP growth plus 1.3%, subtrend. Next year plus 1.8, call it trend. The year after 2.1. So that would be the interplay that I think the market has been driving higher on.
So we're just in a blip of a bit of a slowdown because of the uncertainty from some of the policy. We're looking at the labor market, obviously, but this too shall pass. It sounds like your message is.
The recipe, if our economists are correct, to get back to trend growth would be the Fed's going to ease, so you have monetary tailwind.
Don't fight the Fed.
Do not fight the Fed, particularly in the absence of recession. The history book is very clear on that. The history book is also very favorable when the Fed cuts at or near the highs in the stock market. I think that's only happened 9 times since 1990, 1 year forward, you're higher in all 12 occurrences. So a fiscal tailwind, a monetary tailwind, distance from peak tariff uncertainty, that would be the recipe to get the U.S. economy going again.
All right, so if they're cutting, though, into an uptrend and the market is likely to go up from there, if we're already questioning valuation here, what are we going to say there? Are we going to finally say, you know what, this market's going to have a little bit of a blow-off top kind of a period?
So here's one way to think about it. The market is... The PE is high by any historical standard. So at 22x, you're living in the 96th percentile, again, of kind of modern history, say go back to 1980. The market is concentrated and top heavy. Like, we know that. That's all math. What I'd say, though, is the following, and you and I talked about this for a second before the show. If you look at NDX, in the post-Lehman Brothers era.
You have this crazy stat, which you're going to tell our viewers right now.
Here we go. Since the start of 2009, NASDAQ is up 16 of 17 years. That's total returns, assuming this year will be an up year. 16 of 17. Cumulative return is above 2,200%. And then you ask, well, how much of that was the multiple versus other factors? 75% of it was earnings. 16% of it was dividends. 9% was the multiple. And so if you're going to get skeptical on the market here, you have to be willing to basically say, I'm going to shoot against all of that compounded earnings growth and earnings momentum going forward.
And you are a true believer in the power of those earnings from those companies, even if some of the earnings growth and the revenue growth starts to slow a little bit, which it clearly has, right?
I try to keep it simple, which is in any given moment, there's going to be something that comes off the pace. NVIDIA had 4 down weeks in a row before this week. Google broke out last week to all-time highs. Broadcom broke out to all-time highs. This week, of course, the Oracle story. And so this has been a story, a couple things to say about tech this week. One was Oracle, which for a company of that size, of that maturity, they went public in 1986. To tack on $250 billion of market cap in a day is a statement. I think that is a statement that the AI infrastructure story is still alive and well. We had our marquee tech conference, our Communicopia conference.
Yes, you did.
What stood out to me was you had some of the largest companies in the world get on stage and attach revenue to AI. That's what the market's looking for. Google, Broadcom, of course, Meta, got up and could make that attachment point. I think that's what would continue to power the market.
So when